Let's go ahead and run through the solution to the fourth practice problem from Module 6. Okay, this question involves other comprehensive income. So we have that on January 1st, 2020, Big acquired 60% of Little Company for $360,000. On that date, the fair value of the non-controlling interest was $240,000. Little had owner's equity accounts of common stock and retained earnings and a debit balance in accumulated other comprehensive income. All of their assets and liabilities had fair values equal to book value, except for goodwill, which was recorded as $40,000 on their balance sheet, and which we know, of course, is treated as having a zero value in the consolidation. And during the ensuing 3 years, Little reported income and comprehensive income and paid dividends as indicated in that table. Okay, first let's go ahead and do our differential analysis. We start with the value of the business, or the cost. Our share $360, total $600. Subtract out the book value, and again note that the total book value, common stock $100,000, retained earnings $400,000, minus that debit of $50,000 in accumulated other comprehensive income. Again, AOCI is an equity account, goes into book value. So we have a differential, $150,000 total, our share $90. Add in the overvalued goodwill of $40,000, our share $24. And so the remainder is goodwill of $190,000 or $114,000. So we're going to go ahead and eliminate the $40,000 of goodwill that Little has and replace it with $190,000 of goodwill from this purchase. Of course, that simply results in a net increase of $150,000, which is what we'll do in our elimination entries. Okay, so there's sort of a summary of where we're going to start the ball rolling. We have our beginning common stock, our beginning retained earnings, our beginning AOCI, and we're going to see a net increase in goodwill of $150,000. So first, for 2020, under our equity method entries, we're going to have our purchase of the investment, of course. We record our share, 60% of the reported income. We record our share of the $10,000 in dividends, and we record our share of Little's other comprehensive income. So they have positive or credit other comprehensive income of $20,000. Our share of that is $12,000. Moving over to our elimination entries, we eliminate the beginning of year owner's equity accounts as always, but now in addition to common stock and retained earnings, we've also got that AOCI balance of $50,000 that has to be eliminated. And again, AOCI is starting with a $50,000 debit balance, so to eliminate it, we have to credit it. We go ahead and record that net increase of goodwill of $150,000. That total of $600,000 gets split 60-40 between the investment and the non-controlling interest. Now we need to eliminate the parent's investment income. And again, the parent has two types of investment income. They have their regular investment income, which was $60,000, and they also have their other comprehensive income from their investment. So both of those have to be eliminated. Obviously, those two entries could be netted together, and we'll do that in subsequent years, but just for this first year, let's keep them separate. We do our D for dividends entry in the usual fashion. And now we need to do the income to the non-controlling interest. And again, think of this as being sort of two income calculations running in parallel. First, we have to allocate a portion of the regular earnings to the non-controlling interest, so our income to the non-controlling interest of $40,000. And then we also have to allocate a portion of the other comprehensive income. Again, Little's other comprehensive income was a $20,000 credit, so we're taking away $8,000 and allocating it to the non-controlling interest, hence the OCI to NCI debit. Okay, moving on to 2021. Note the changes at the top of the page. Common stock is still $100,000. The new retained earnings balance is now up to $490,000, and our new beginning AOCI is a $30,000 debit. Again, initially it was a $50,000 debit. Last year, Little had $20,000 of other comprehensive income, which reduced that debit down to $30,000. In any event, we do our equity method entries. Income, our share of the reported $120,000. Dividends, our share of the $10,000 in dividends. And then our other comprehensive income from our investment. Again, Little has a $40,000 credit to to other comprehensive income, our share of that is $24,000. They have OCI, we have OCI. Our elimination entries, again, we eliminate the subsidiary's common stock and retained earnings, and we eliminate that $30,000 AOCI debit balance. We carry forward our goodwill. That total of $710,000 gets split 60-40 between the investment and the non-controlling interest. We go ahead and eliminate the parent's investment income. And again, let's go ahead and net what we previously treated as two separate entries. Let's go ahead and net those two things together. So we're going to eliminate the parent's sort of regular investment income. We're also going to eliminate their other comprehensive income from their investment for a combined credit to the investment in little of $96,000. We do the dividends in the usual fashion, and now we're going to go ahead and allocate the earnings to the non-controlling interest, and again, we'll net together both the regular earnings and the other comprehensive income to the non-controlling interest. So they get $48,000 of the regular earnings, they get $16,000 of the other comprehensive income. Those two things combined, $64,000, increase the non-controlling interest. Again, the earnings and the other comprehensive income increase Little's reported value, which increases the non-controlling shareholders' equity interest in that ever-increasing subsidiary. Finally, for 2022, again, note the changes. Retained earnings is now up to $600,000. AOCI has finally switched over to the credit column because of the 2 years of preceding credits to other comprehensive income. Equity method entries in the usual fashion. Our share of the reported earnings, our share of the dividends. And now we need to be a little bit careful because in 2022, Little, the subsidiary, has a $20,000 other comprehensive loss. So they have a debit to OCI of $20,000, which means we have a debit of $12,000 to OCI. They have a loss, we have a loss. We go ahead and go to our elimination entries, and again, common stock and retained earnings in the usual fashion. Now is a change of pace. The AOCI now has a credit balance, so to get rid of it, we're going to debit it for $10,000. We carry forward that ever-present $150,000 in goodwill. That total of $860,000 gets split 60-40 between the investment and the non-controlling interest. We go ahead and eliminate the parent's investment income and the parent's OCI from the subsidiary. And again, just note that we have to be careful here. In 2022, the parent debited OCI for their share of the other comprehensive loss, which means to eliminate it, we have to credit OCI for $12,000. Dividends in the usual fashion. And again, for the income to the non-controlling interest, they get their share of the reported earnings of $80,000. We're going to allocate to them $8,000 of the $20,000 debit balance in other comprehensive income, and that has a net increase in the non-controlling interest of $24,000.